If I told you there's a portfolio designed to survive prosperity, inflation, recession, and deflation without changing the strategy, you'd probably assume it's either too conservative to matter or too good to be true. It's neither. It's just built for a different goal. It's called the permanent portfolio, popularized by Harry Browne, the legendary investor, and it's basically the cleanest, I don't want to predict the future portfolio ever designed. It's not built to beat the stock market every year. It's built to help you stay invested when the world changes faster than your predictions, especially in a year like 2026. In this video, I'm going to explain what the permanent portfolio is, how it works, which tickers you can use to build it, and what its historical performance has looked like, including this combo's annual return and max drawdown. The permanent portfolio is simple: 25% stocks, 25% long-term US Treasury bonds, 25% cash or Treasury bills, and 25% gold. That 25-25-25-25 split is the whole point. It's a four corners portfolio. Instead of trying to guess what's coming next, you permanently hold one asset that tends to do well in each major economic climate. Here's the logic in plain English. When the economy is expanding and corporate earnings are growing, stocks tend to lead. When there's recession fear or deflation pressure and interest rates fall, long-term Treasury bonds can surge. When the world is uncertain or rates are rising, cash and Treasury bills act like the shock absorber. They don't shoot the lights out, but they stabilize the portfolio and give you dry powder. And when inflation rises, currencies get questioned, or trust breaks down, gold often behaves like the insurance policy. So you're not trying to be right about the next headline. You're trying to be prepared for all of them. Now here's how the strategy works mechanically. You set the four slices at 25% each, and then you rebalance periodically. The classic way isn't daily trading. It's a disciplined, boring check-in. For example, if you start with $1,000 split to four ways, a year later, stock section jumps, so they're now 31% of the portfolio, and long-term treasuries fall to 20%. The boring check-in is simply selling a little of the stock slice and using it to buy enough treasuries to bring everything back to 25% each. Some people rebalance once a year. Others rebalance only when things drift far from 25%. A common band approach is, if any slice falls below about 15% or rises above about 35%, you rebalance back to 25%. Rebalancing is the engine. It forces you to trim what got expensive and add to what got cheap without needing to predict anything. Now let's make this concrete with tickers you can actually use. For the stocks 25%, the simplest and best choice is a broad US equity ETF. One's choice is VTI, which holds the entire US stock market, large, mid, and small caps, so it's the own everything option. Another option is VOO, which tracks the S&P 500, so it's more concentrated in the biggest US companies. Either works as the growth engine. For the long-term Treasury bonds 25%, a common proxy is TLT, which holds US Treasuries with maturities around 20 years and longer. This slice is there because long-duration Treasuries can rally hard when growth scares hit and rates fall. For the cash or T-bills 25%, you want very short duration Treasury exposure, basically cash with interest. BIL holds 1 to 3 month Treasury bills, and SGOV is similar, holding short-term Treasuries with very low interest rate risk. This is your shock absorber and your dry powder for rebalancing. For the gold 25%, use a bullion-style ETF like GLD or IAU, which are designed to track the price of physical gold rather than gold mining stocks. This slice is your inflation and currency stress insurance. Now let's talk performance, because this is where expectations matter. The permanent portfolio is not designed for maximum return. It's designed for survivability with decent returns. Across a long US backtest using common proxies and periodic rebalancing, the permanent portfolio has historically produced roughly a high single-digit nominal return, with a much smaller maximum drawdown than a stock-heavy portfolio. One widely used long-run backtest framework for 1996 through 2025 shows an annualized return of about 7% and a maximum drawdown around minus 16%. In real inflation-adjusted terms, that same period comes out closer to the mid-4% range. So what does that mean in human language? It means you probably won't beat a pure stock portfolio in a big bull market, because 3/4 of the portfolio is not stocks. But you also tend to avoid the kind of portfolio trauma that causes people to panic sell at the worst possible time. Now, it's not magic. There are still bad stretches. A modern example is 2022, when both stocks and long-duration bonds were hit hard at the same time. An ETF-style permanent portfolio implementation during that period saw a drawdown around the high teens, roughly minus 19%, before recovering later as conditions changed. That's an important lesson. The permanent portfolio is not a never goes down portfolio. It's a doesn't usually go down as brutally as stocks alone portfolio, and it often recovers through rebalancing when one slice rebounds and much faster. So here's the trade-off you're accepting. You trade upside in long stock booms for a smoother ride across different regimes. If you're young and your only goal is maximum growth, a 25% stock allocation may feel too conservative. But if your goal is to build a portfolio, you can hold through almost anything, especially if you're worried about inflation shocks, recession shocks, or rate shocks. The permanent portfolio becomes much more attractive. And if you do implement it, the most important part is discipline. The allocation is simple, but the behavior is hard. You have to rebalance when it feels uncomfortable. You have to buy what just lost and trim what just won. That's the permanent portfolio in one sentence. A 4-asset, 25% each structure designed to survive any economic climate, using rebalancing as the engine, with historically moderate returns and historically smaller drawdowns than equity-heavy portfolios, but with the trade-off that it will often lag during strong stock bull markets. Consider taxes, account type, fees, and your own risk tolerance before copying any allocation.